The JEPI ETF may be suitable for investors who are looking for an investment vehicle that doesn't only provide a steady stream of monthly income, but also offers the potential for capital appreciation. Now, in the past, the high-yielding covered call ETF, known as JEPI, has provided a substantial amount of income on a monthly basis, while holding mostly steady as far as the ETF share price. But as of recently, it seems like many of these things have changed. With the latest dividend announced just a few days ago, for JEPI being only 37 cents per share, some dividend investors, including myself, are worried that the high-yielding ETF might be no such thing anymore. Now, in this video, we are going to do a deep dive into the JP Morgan Income ETF and explain things like what the ETF even is, how it works, and why the dividends seem to be getting lower and lower as time goes on. Now, we're going to go over all this and more right after you please drop a like in this video and subscribe for more content like this. Now, first off, I think it's important for us all to be on the same page here. I currently own around 1,000 shares of JEPI throughout my multiple dividend stock portfolios. Now, I've been buying JEPI on and off for the past few years now, in the hopes for JEPI to be able to cover some of my monthly bills in the future, but for now, I've been using my JEPI dividends to reinvest into more shares of whatever seems to be on sale on whatever given day. Now, back when I first started buying into JEPI, the dividend was much higher than it currently is today. And although over the past few months, JEPI's dividend seems to be going lower and lower, I was hopeful that June's dividend was going to be much higher and definitely turn things around from here. But let's back up for a second and go over what the JEPI ETF even is. So the JP Morgan Equity Premium Income ETF is an exchange-traded fund that seeks to provide income and capital appreciation by investing into a diversified portfolio of equity securities, primarily U.S. large-cap stocks, as well as selling covered call options on those holdings. So in simple terms, the JEPI ETF invests in a basket of stocks that are selected based on certain criteria. Things like market capitalization, liquidity, and financial performance. The fund manager then sells call options on a portion of these stocks, which generate income for the fund in the form of premiums paid by the buyers of those options. Now, if you're not familiar, call options are contracts that give the buyer the right, but not the obligation to buy an underlying stock at a predetermined price. Now, this is known as the strike price. On or before a certain date, this is known as the expiration date. When the fund manager sells call options, they receive premiums, and these are paid by the buyer's side. Now, when it comes to JEPI, these premiums generate additional income for the fund. So simply put, the managers of JEPI buy into a basket of stocks, sell covered calls on those stocks, and wait and see what the market's going to do that month. Now, depending on how the market trades within that given month, depending on how the volatility is, and if some of the shares in the fund get called away or not called away, all these different factors are going to determine what the JEPI ETF's dividend is going to look like. And because of this exact reason, this is why JEPI's dividend history looks the way it does. At times, JEPI's paid out over 50 cents per share per month, which is well over a 10% yield annualized. And then at times, JEPI's paid as low as 26 cents. And as you can see, pretty much everything else in between. Now, during the end of 2022, JEPI was paying out quite a bit per share in the 61-cent range. And then since then, in January, JEPI paid out 44 cents, then it paid 41 cents, 45, 42, and now 37 cents, which was very disappointing to a lot of us income investors. Some more quick facts about JEPI. The actual ETF is up 5.32% as of all time, which is significant and which is something sort of rare that you see for a fund that has as high of a yield as JEPI does. For example, something like QYield, QYLD, a fund that has a trailing 12-month dividend yield somewhat similar to what we see with JEPI. QYield has a minus 30.44% return as far as share price. Now, JEPI's only been around for a few years, QYield has been around a lot longer, but either way, this sort of puts things into perspective on how decent JEPI's traded so far. Now that you understand exactly how the JP Morgan Income ETF works, these are just a few of the 136 holdings that JEPI currently has. Here's the top 10. JEPI holds Microsoft, Amazon, Adobe, Hershey, Accenture, MasterCard, Pepsi, Alphabet, Progressive, and Comcast. All for the most part very solid companies that have a long track record. And remember, JEPI does sell covered calls on the basket of stocks, which does cap the upside potential but also helps during volatility. Another interesting metric to pay close attention to, while JEPI's been lowering their dividend over the past few months, is to see, with dividends included, how the fund has performed year to date. Now, year to date, with dividends included, JEPI's returned 3.72%, where the S&P 500 has returned 12.81%. So it's pretty obvious that investors would have been much better off so far this year just buying into the S&P 500 rather than even messing around with the high income ETF known as JEPI. Over the past 365 days though, JEPI's actually returned higher than the S&P at a 5.26% versus a 4.32% return. The last 3 years, JEPI's pretty much stuck with the S&P 500 at a 40.6% total return, where the S&P has returned 45.79%. So this leads us back to the most important question. Is JEPI's dividend going to continue to go down from here? And is this high-yielding ETF even worth investing into? Now, of course, high-yielding ETFs like this are an attractive option for investors like myself that are looking to generate more income on a consistent basis. However, with the way that JEPI's dividends have looked over the past 6 months now or so, and the pretty hefty expense ratio of 0.35%, income investors like myself are going to have to start asking ourselves, is there a better ETF out there, or even a single stock, that's going to offer a safer total return that could even beat something like this higher yielding ETF? Now the answer to that question is there probably are other options out there. But for the more income-oriented investors that are okay with maybe having their monthly income be moved around a bit, depending on how many dividends, premiums, and profit the fund has generated on a monthly basis, then I don't necessarily see any problem whatsoever with having something like JEPI in their portfolio. But on the other hand, I will say it is nice to be invested into single name stocks and or ETFs, closed-end funds, things like that do pay more of a consistent monthly or quarterly payout. Just because as you get further and further into your investing journey, it's sort of nice to know or have an idea of how much a fund or single stock is going to pay you on a monthly or quarterly basis. Because after all, the more and more shares of an ETF like JEPI, for example, that you're going to collect, the amount that you're going to get paid is going to be drastically different 1 month to the next if the fund is paying out things like 60 cents per share versus 37 cents per share. And that's definitely going to be even more important for the investors that are looking to maybe live off the income, retire off the income, have it cover their bills, etc. Like for example, if an investor has purchased 1,000 shares of the JP Morgan Income ETF JEPI in order to help cover some of their bills, if 1 month JEPI pays 62 cents per share, that means that in theory that investor on that month would receive $620, which is great. But on the next month, JEPI pays 50 cents per share, let's say. On that month, this investor would receive $500 for their investment to JEPI. And then moving all the way forward until what JEPI's offering as of the last ex-dividend date. JEPI's paying 37 cents per share. So for the investor that owns 1,000 shares of JEPI that, let's say, for example, uses this investment to help cover bills, this month they would only receive $370. So it's pretty obvious that for investors that are looking to live off of their income generated from dividends, the JEPI ETF is not going to be very consistent and could definitely potentially get some investors into trouble. But I want to hear what you guys think down below when it comes to JEPI. Do you think investors should be concerned about the lower and lower dividends that have been paid out as of recently? Or do you think that it's just the fund's normal mechanics, and because or not because of the market volatility, and it's because the way the market has been recently, which is why JEPI's been paying what it has been? If you enjoyed this video and you want to see more videos like this in the future, make sure to please drop a like down below and subscribe for more content like this. Thanks as always for stopping by, guys, and I'll see you in the next one.